Welcome to the Deep Dive. This is where we dig into the research you send our way and pull out what you really need to know. Today, we're tackling something pretty scary, honestly, and it's growing fast. Stealth fraud that targets your retirement savings.
That's right. And we're not talking about the usual anxieties like, market dips or maybe making a less than stellar investment choice. This is different. We're looking at really sophisticated criminal operations. Their whole game is getting you, the actual owner of the account, to basically empty it yourself through, well, manipulation. Social engineering.
It sounds like the ultimate betrayal.
It is. It really is.
Okay, let's try to paint a picture here. One that unfortunately way too many people, especially over 60, are finding themselves in. Picture this. You've worked for decades, right? Saved diligently. Maybe you've been putting money into your 401k, your IRA, and finally you hit that number, that magic six-figure mark, maybe more.
Yeah.
You feel secure, you're done it, you're ready to, relax, enjoy things. And then the phone rings, or you get a text, an email, unexpected.
And the hook is often just perfect. The person on the other end sounds professional, sometimes friendly, even warm. They know your name. Maybe they know roughly how old you are. And crucially, they don't start with threats. Not usually. They're offering help. Maybe it's an exclusive investment opportunity that sounds amazing.
Or maybe something even trickier.
Or, and this is really sinister, they might pose as someone from a legitimate, powerful organization, like the government, the FBI, even your own bank's fraud department.
That illusion of security, that's what makes it so incredibly damaging, isn't it?
Absolutely.
Because the hard truth, the statistics bear this out, is that people over 60 are the prime targets. Why? Because that's where the accumulated wealth often is.
Exactly. They represent this large pool of assets that can be moved, liquid funds.
And the scale. You mentioned the FBI's Internet Crime Complaint Center, the IC3. What did their 2023 numbers show?
It's frankly shocking. Victims over 60 reported losses of over $3.4 billion.
Billion, with a B.
With a B. And listen, that's just what got reported. Think about how many people might be too embarrassed or confused or just devastated to even file a report. The real number, it's got to be higher.
$3.4 billion gone in 1 year. Just from seniors. That's like the entire budget for some small countries.
It is. And what's really alarming beyond the sheer size is how fast it's growing.
Right. You mentioned that.
Yeah, that $3.4 billion, that was an 11% increase from the losses reported in 2022.
Wow. An 11% jump in just 1 year.
And while, the average loss per victim was around $33,915, which is bad enough, the real devastation is often concentrated. The FBI data shows nearly 6,000 older adults lost over $100,000 each in 2023.
6,000 people losing six figures or more.
These aren't small bumps in the road. These are life-destroying events. They steal people's independence, their security, everything they worked for.
There's one case, Judith Boyvin's story, that just perfectly illustrates this whole predatory playbook, doesn't it?
Oh, her story is just heartbreaking. 80 years old. A retired therapist. And over months, back in 2023, she was completely convinced by a scammer. This person pretended to be a government official. They told her she was secretly helping the FBI take down a dangerous drug cartel.
Helping the FBI?
Yes. And the cover story was that her own money was at risk of being seized by these criminals. So to safeguard her assets, this imposter guided her step by step.
To do what?
To drain her own retirement account. Systematically.
She thought she was being a good citizen, protecting her money.
Protecting the country, even. And instead, she was manipulated into transferring over $595,000 out of her 401k.
Almost $600,000 gone.
Gone.
So our mission today in this deep dive is really to unpack how these scams work. Specifically, how they use this imposter strategy, how they engineer these so-called authorized rollovers to get the money out.
And critically, the financial nightmare that comes after the money is gone, the tax bomb.
Right. And of course, what you absolutely need to do to protect yourself, the rules you just can't ignore.
Let's start with how they build that trust. Because this isn't just, a simple email asking for your password. It's way more elaborate. It's about establishing what FINRA calls source credibility.
Source credibility. Okay, what does that mean in practice?
It means the scammers build this believable front. They misuse the names, the details, all publicly available stuff of real, registered financial professionals or well-known companies.
So they piggyback on legitimacy.
Exactly. They know that if they use a name or a firm that you've heard of, or maybe one you can quickly Google and see looks real, it just lowers your guard immediately.
It feels like a new kind of identity theft. Stealing someone's professional reputation to commit fraud.
It really is.
What are the specific tools in their imposter toolkit?
Well, it starts online. They build these incredibly realistic imposter websites.
Fake websites.
Totally fake.
Right.
But they look completely legitimate. They'll take the name, the photo, the credentials, the work history, everything they can find publicly about a real licensed professional.
Someone with a good reputation.
Preferably, yes. And they build a fake site around that identity. The goal: get your personal info, maybe your login details for your real accounts, or convince you to make a small initial investment into their fake platform.
So let me get this straight. I get an unsolicited call. They give me a name. I Google it. Boom, up pops this polished website. It confirms everything they said. I might think, okay, seems legit. But the website itself is the trap.
Precisely. You've just verified the stolen identity on a fake platform controlled by the criminal.
And it goes beyond websites, right? They fake documents too.
Absolutely. The FINRA specifically warns about this. Scammers are creating fake versions of official regulatory reports. Think about something like a FINRA BrokerCheck report.
But that's the report investors use to check a broker's background, their history.
Exactly. It's supposed to be a key safety tool. These scammers will take the report of a real professional, someone with a clean record, maybe slightly alter it, or create a copy.
They're literally stealing the proof of good conduct. How do they pull that off technically?
They use the real professional's name, and crucially, they often use their real CRD number. That's the unique ID number every registered broker and firm gets.
The Central Registration Depository number. That's supposed to be the verification key.
It is. But here's the trick. They take that real CRD number, which builds trust, but they associate it on their fake documents or fake website with a company name that isn't actually registered with FINRA or the SEC.
Wait. If they use a real CRD number, how isn't that immediately flagged? Where's the gap?
The gap is often in the follow-through.
Yeah.
The scammer sends you the fake document or directs you to their fake site. They're banking on the fact that once you see the real name and the familiar CRD number, you'll stop digging.
You trust the number.
You trust the number and the name it belongs to.
Yeah.
But the money is being directed to a completely different, unregistered entity. The responsibility, unfortunately, falls on you, the potential victim, to cross-reference that the firm name they're giving you actually matches the official registration tied to that CRD number on the official BrokerCheck or IAPD site. Most people don't take that extra step.
It's exploiting the very systems designed for transparency.
Absolutely weaponizing them.
And beyond stealing identities, they also adapt to what's happening in the market, right?
Oh, they're masters at playing on current events, fear and greed. When the market's volatile, like it has been, they suddenly pivot. They start offering these fictitious products promising stability, maybe lower returns, but guaranteed.
Playing on the fear of loss.
It is actually. Then you see something new emerge, like crypto assets gaining attention. Boom, they're all over it. Offering access to exclusive crypto funds or setting up fake trading platforms that look real but just funnel your deposits straight into their digital wallets.
And then there's this really insidious tactic, affinity fraud, that seems to bypass all the technical checks.
Affinity fraud is just, it's terrible because it leverages trust within a community. They target victims based on something you share, maybe religion, ethnicity, maybe you're part of the same professional group, or even just share a hobby or belong to the same online forum.
Like the Bernie Madoff case.
That's a classic, tragic example. The source material mentions how he targeted respected Jewish leaders and foundations. Why? Because there was an inherent trust there based on that shared community connection. He didn't have to sell the investment as hard. The referral from within the community did the selling for him.
So the trust isn't built on the investment's merit, it's built on the relationship.
Precisely. It makes it so much harder to be skeptical. You think, well, my friend from church recommended him, or so-and-so from the club invested. It just completely lowers your defenses in a way a cold call never could.
Okay, so they've built this credibility, maybe through fake websites, maybe affinity. Now they need to push the victim to actually make the transfer. What are the key red flags, the psychological triggers they use?
The number one tactic is urgency. Always urgency. Sometimes it's framed as fear of missing out,
Right.
FOMO. The Canadian Securities Administrators, the CSA, they nail this. Fraud promoters demand quick action. Why? To stop you from doing your homework, to stop you from researching the investment, talking to an independent advisor, or even just thinking it through properly.
This offer expires at midnight. Or price is going up tomorrow. That kind of pressure.
Exactly. It's a race against the clock, and for them, the clock running out means you might figure out it's a scam.
What else?
Another huge one, unsolicited contact. especially if they try to act overly friendly. Establish this kind of casual familiarity right away. If you weren't looking for an investment, if you didn't reach out first, and someone contacts you out of the blue claiming they can make you rich, red flag. Big one.
Legitimate advisors usually don't need to cold call constantly.
Generally, no. Their business comes from referrals, existing clients. Be very wary of the cold pitch.
And the promises they make about returns.
Oh, totally unrealistic promises. That's a classic. Anything offering guaranteed high returns, like 12% guaranteed, or investments pitched as risk-free but with high returns.
Always a catch.
Always. Legitimate investing involves risk, period. Any guarantee of unusually high returns, especially risk-free ones, that should scream scam. The NJ Bureau of Securities is very clear. View those promises with extreme skepticism.
Okay, let's say they've got you hooked. You're tempted. Is there a final red flag in how they ask for the money?
Yes. Watch out if they suddenly start asking for extra fees. Unexpected charges, maybe taxes they claim you need to pay before you can withdraw your supposed profits, or even your initial investment. Legitimate firms don't usually operate like that.
And there's a psychological trap, too, isn't there? Something about being polite.
Yeah, the NJ Bureau calls it the courtesy victim trap. It's sad, but many victims later admit they felt pressured, they kind of knew something was off, but they didn't want to be rude. They didn't want to just hang up on this person who sounded so nice or so professional.
You have to overcome that politeness.
You absolutely have to understand this. Saying no firmly is your best defense. Asking for time, asking for things in writing, saying you need to discuss it with family or an advisor, and ultimately just hanging up. That's not rude, that's smart. That's protecting yourself.
Okay, now let's get to the absolute core of how these huge retirement accounts actually get emptied. This is the really stealthy part. It's not always some super hacker breaking through firewalls.
Right. In many of the most financially devastating cases, the victim themselves, under these false pretenses we've discussed, authorizes the withdrawal. They greenlight the whole thing.
This is the social engineering climax.
Exactly. The scammer convinces the victim, like Judith Boyven, or the person called Taxpayer One in that IRS memo, that their money is in terrible immediate danger.
What kind of danger?
Could be anything. Your account has been compromised by hackers. We suspect illegal activity linked to your account. You're part of a secret government investigation, and we need to secure your funds. The story varies, but the solution they offer is always the same.
Which is?
You must safeguard your money right now. You need to move it immediately to this secure temporary account. Or maybe they call it a digital locker or an escrow account. It's actually an account controlled entirely by the scammer.
So the victim is the one on the phone with their real, legitimate brokerage. Fidelity, Schwab, Principal, wherever their 401k is.
Yes, they are making the call.
And they're saying, I want to do a rollover. Or I want to make a distribution.
Precisely. They are voluntarily, actively authorizing a distribution or a rollover from their existing retirement account, their IRA, their 401k, directly to the scammer's designated account.
And from the financial institution's perspective.
It looks perfectly legal. The authorized account holder requested it. They followed the security protocols, maybe answered the security questions, used their password. The custodian processes the request, sends the check, or initiates the wire. They aren't typically liable for the fraud that happens after the money leaves their control because their customer authorized it.
Now, we know taking money out of a 401k while you're still working, an in-service withdrawal, is usually pretty restricted, right? Like loans or hardship cases.
Generally, yes. But once you leave your job or retire, liquidating that account or rolling it over into an IRA is a very standard procedure. And even some active plans allow for certain types of in-service rollovers or distributions.
And that process, turning investments into cash and sending it out via check or wire, it takes a few steps.
It does, and it's in those steps, that potential delay, where immense anxiety can build, especially if something seems off. There's that story on Reddit. It ended up being okay, but it perfectly captures the fear around this specific mechanism.
Right, tell us about that one.
Okay, so this user posts in a total panic. Their entire 401k, something like $62,000, just showed a zero balance, vanished.
Oh my God.
And the transaction history showed a check had been issued right before a long holiday weekend.
The worst timing.
Exactly. Imagine that feeling. Your life savings, gone. They're frantically calling the fraud department, getting voicemail because, you know, holiday weekend, nobody's there 24/7. They spend the whole weekend filing police reports, freezing their credit, absolutely convinced a scammer had timed the heist perfectly to drain the account while the custodian was closed.
That level of panic,
Yeah.
it's hard to even comprehend.
Totally overwhelming. Now, in that specific case, there was an update later. It turned out to be a legitimate change of plan custodians that was just communicated terribly. No fraud occurred.
Okay, so false alarm in that instance.
Yes, but the reaction is what's important. It highlights the sheer terror this specific scenario induces, and it underscores just how vulnerable people feel and how critical speed is when a fraudulent transfer does happen, because those checks and wires...
Hard to stop, hard to reverse.
Extremely hard, especially wires. Once that money is wired out, particularly if it's sent overseas, which is very common in these sophisticated international scams, it's often gone instantly. The trail goes cold very, very quickly.
Losing the principal, the life savings, is obviously catastrophic. But there's another layer to this nightmare, isn't there? The double loss you mentioned earlier, tax implications.
This is absolutely crucial and often completely overlooked until it's too late. It comes straight from that IRS chief counsel memo in cases like Judith Boyvin's. When money comes out of a tax-deferred retirement account, like a traditional 401k or IRA, it's considered a distribution.
Meaning it's taxable.
Fully taxable as ordinary income. In the year it was taken out, it doesn't matter if you never touched it, if it went straight to a scammer. The IRS sees it as income to you in that year.
So Judith Boyvin, she lost the $595,000, but then...
Shows she got hit with the tax bill. Over $137,000 owed to the IRS. Another $42,000 or so to their state, Maryland. Almost $180,000 in taxes due immediately on money she never, ever benefited from.
She was wiped out twice, first by the scammer, then by the tax code. How is that possible? Why couldn't she just deduct the $595,000 as a theft loss?
That's the devastating part. It boils down to a specific change made by the Tax Cuts and Jobs Act back in 2017.
Okay, what did that change do?
For the tax years 2018 through 2025, it essentially disallowed deductions for most personal casualty and theft losses.
Personal losses. So there's a distinction.
A critical one. The IRS analysis hinges entirely on your motive when you transferred the funds. Were you trying to make a profit, or was it for a personal reason?
Okay, so how does the IRS view a loss if you thought you were making an investment?
Well, if your clear intention was to reinvest the money, hoping to make a profit, the loss might be deductible. The IRS memo talks about taxpayer 2, someone caught in a pig butchering scam.
That's where they build a relationship and convince you to invest in fake crypto platforms.
Exactly. That person transferred money because they genuinely believed they were making a profit-seeking investment. It was fake, but their motive was profit. So the resulting theft loss could potentially qualify as a loss incurred in a transaction entered into for profit under the tax code section 165C. That might be deductible against other income.
But Judith Boyvin's motive, she wasn't trying to invest with the drug cartel.
No, not at all. Her motive was purely personal, safeguarding her assets, protecting herself based on the scammer's lies.
And the IRS memo mentioned other examples, romance scams, kidnapping scams.
Yes. Taxpayer 4 in a romance scam, taxpayer 5 paying a fake ransom in a kidnapping scam. Their motives were personal connection, personal safety, preventing harm, not profit.
So their losses are classified as personal casualty losses.
Correct. And because those personal casualty losses are generally disallowed for tax years, 2018 through 2025,
They're stuck. They have to report the withdrawal as income, pay the tax, but they get no offsetting deduction for the fact that the money was immediately stolen.
that's the brutal reality. The IRS memo is crystal clear. Even if you prove the theft happened, if the motive behind the transfer was personal during this time frame, the loss is non-deductible for federal income tax purposes. It's this quiet legal catastrophe that follows the crime itself.
And you mentioned there's some legislation trying to fix this.
Yeah, the source material notes there's been bipartisan effort in Congress to try and restore the deductibility for these types of fraud losses, but it's been stalled. So as of now, this tax trap is still very much in effect. It makes the financial devastation absolute.
Okay, so knowing all this, the sophisticated tactics, the rollover mechanism, the tax trap, how do we defend ourselves? What's the first line of defense?
It has to be extreme, unrelenting skepticism towards any unsolicited contact, full stop.
Golden rule of contact, right?
Absolutely. It sounds simple, but it gets violated because scammers are good. They sound professional, maybe even charming, but you have to internalize this. Never, ever trust someone claiming to be a financial advisor or a government agent who calls, texts, or emails you out of the blue and demands immediate action, especially involving money or sensitive information.
Government agencies just don't operate that way.
Never. MoneyWise points this out clearly. The IRS, FBI, Social Security Administration, they will never initiate contact by phone, email, or text to demand money, ask for personal details like your Social Security number, or threaten you with arrest if you don't pay immediately. That's always a scam.
And you have to fight that urge to be polite, the courtesy victim trap.
You must. Remember the advice from the NJ Bureau of Securities? Saying no is your power. Asking for time, saying you need to verify them independently, hanging up, these are essential defenses. Don't worry about being rude. Worry about protecting your life savings.
Beyond just resisting the pressure, what about securing the accounts themselves? The digital security layer.
This is foundational. You have to lock down your online access. Principal and really all financial institutions now stress this. Multi-factor authentication, MFA, is absolutely critical.
And not just a password.
Not just a password. MFA adds that second layer, usually a code sent to your phone or generated by an app. It's like having 2 locks on your door instead of 1. If your bank or brokerage offers MFA, you need to turn it on. Period.
We hear about MFA a lot. But are there weaknesses even with MFA?
Yes. The main weakness is how you get that second factor. Many people still rely on SMS text messages for the code. The danger there is something called SIM swapping.
Where they steal your phone number.
Essentially, yes. Scammers trick your mobile carrier into transferring your phone number to their device. Then, when the bank sends the MFA code via text, the scammer gets it, not you.
So, SMS isn't foolproof. What's better?
Much better is using an authenticator app. Things like Google Authenticator, Microsoft Authenticator, Authy. These apps generate time-sensitive codes directly on your device. They can't be intercepted through SIM swapping because they don't rely on the phone network for delivery. Use an app if you possibly can.
Good tip. And passwords themselves, still important.
Absolutely. But we need to think differently. Ditch the short, easy-to-guess passwords. Think passphrases instead.
Longer, more complex.
Longer, yes, but also memorable to you. Principle suggests combining unrelated words, numbers, symbols, something like 94 Lemon Brown Mountain. It's long, hard for computers to guess, but maybe you can remember. 94 Lemon Brown Mountain and the symbol. Length and randomness are key.
Okay, MFA with an app, strong passphrases. What about keeping an eye on things?
Vigilance. Simple but crucial. First, make sure you've actually registered for online access to all your financial accounts. Don't leave them dormant online.
Check them regularly.
Yes. Log in at least monthly, maybe more often. Just scan for any transactions you don't recognize. And critically, set up alerts. Most institutions let you get email or text alerts for things like large withdrawals, wire transfers, or changes to your contact information like your phone number or email address. Turn those alerts on.
And a basic safety tip.
Avoid doing sensitive financial stuff on free public Wi-Fi, like at the airport, coffee shop, hotel. Those networks are often insecure, making it easier for criminals to potentially intercept your information. Stick to your secure home network or use your phone's data connection.
Okay, final defense layer. And maybe the most important, given the imposter scams. Vetting. How do we absolutely confirm someone is who they say they are?
You cannot trust the documents or websites they provide you. You must go directly to the independent official sources.
The regulatory databases.
Exactly. The ones designed specifically to protect investors.
Remind us what those key tools are again.
There are 3 primary ones you should always check. First, FINRA's BrokerCheck system. That's brokercheck.finra.org.
Okay, BrokerCheck.
Second, the SEC's Investment Advisor Public Disclosure Database, or IAPD. That's at advisorinfo.sec.gov.
IAPD. Got it.
And third, don't forget your specific state securities regulator. You can usually find their contact info through the North American Securities Administrators Association, NASA website. Contacting them directly can be very helpful.
Why are there 2 big federal databases, BrokerCheck and IAPD? What's the difference?
That's a really important distinction people often miss. FINRA's BrokerCheck primarily covers broker-dealers and their registered representatives. Think of them mainly as facilitating transactions, buying and selling securities, often for a commission.
Oh.
The SEC's IAPD database primarily covers investment advisors and their firms. These folks typically provide ongoing financial advice, manage portfolios, usually for a fee based on assets under management.
And some people might be registered as both.
Many are. That's why you really need to check both databases. It gives you the full picture, their qualifications, their employment history, and crucially, any disciplinary actions, customer complaints, or regulatory red flags.
So I get a name. I go to BrokerCheck and IAPD. What exactly am I looking for? What are the potential inconsistencies?
Look closely for subtle differences. Does the firm name they gave you exactly match the name on the official record? Is the address slightly different? Is the phone number listed on the official site different from the one they called you from or gave you?
Little details matter.
Hugely. And check their CRD number. Does the CRD number they gave you actually pull up their name and the firm name they stated on the official site? Read the disclosure sections carefully. Any past issues, any complaints, any little mismatch, any red flag is an immediate reason to stop all contact.
What about those fancy-sounding titles, like Certified Senior Advisor or Retirement Income Specialist?
Be very skeptical of impressive-sounding designations, especially if the person heavily promotes them. The NJ Bureau of Securities specifically advises checking with your state regulator to see if that designation is actually legitimate, accredited, and relevant. Some sound official, but require minimal training.
So the bottom line on vetting is?
The bottom line is absolute verification before you do anything else. Never send money, never send crypto, never give out sensitive personal information, driver's license, social security number, account numbers, until you have independently verified that individual and their firm through those official BrokerCheck, IAPD, and state regulator channels. No exceptions.
Okay. We have taken a really deep dive today into the mechanics of this stealth fraud. We've seen it's less about sophisticated hacking and more about sophisticated manipulation social engineering that tricks the victim into authorizing what looks like a legal transfer, like a rollover, but has utterly devastating results.
Yeah, the key takeaways for you listening right now are just crystal clear, I think. First, maintain that extreme skepticism, especially with unsolicited calls or messages. Don't trust, verify. Second, lock down your digital defenses. Use strong, unique passphrases. Use multi-factor authentication, preferably an authenticator app, not just SMS. Keep an eye on your accounts. And third, mandatory independent verification. Use BrokerCheck. Use IAPD. Contact your state regulator. Every single time someone new approaches you about investments, don't rely on what they send you.
And resist that pressure. Resist the urgency.
Absolutely. That's the scammer's main weapon. Time is your friend. It allows you to think and investigate.
You know, what really strikes me is that the biggest weak point often isn't the bank's firewall or the encryption. It's us. It's the human element. It's the trust that these criminals are so good at engineering us into giving away.
It's true. And the scale. When the FBI says investment scams were the costliest fraud category for seniors in 2023, hitting over $1.2 billion in losses just in that group, it's staggering.
So let's leave our listeners on the final thought. If we connect all this, what does it really mean for how you should think about your financial future?
Well, I think it raises a pretty fundamental question. We spend so much time worrying about market risk, about choosing the right stocks or funds, about inflation. But what does it mean for your retirement planning when arguably the most devastating financial threat you face today isn't market volatility at all? What if it's these deliberate, sophisticated, human-targeted attacks on your financial identity? Attacks that, as we've seen, can not only drain your savings, but also leave you with a massive, undeductible tax bill long after the thief is gone.
It fundamentally changes how we need to think about financial security, doesn't it?
It really does. Protection isn't just about asset allocation anymore. It's about vigilance, skepticism, and digital hygiene.
A sobering thought. Maybe a good reminder for everyone listening to go check their MFA settings right now. That's our deep dive for today. Thanks for joining us. We'll see you next time.